Dan, you bring up a very interesting issue, which is the international markets and our dependence on them. Recently, I read an article, I believe it was in the New York Times, talking about how a lot of old wells that had been capped, they're now starting to reopen and look for oil again. What are your thoughts on that movement, and what is driving this? Is it technology, and how do I, as an investor, potentially make money on that? Are there stocks that I should be looking at in this whole movement?
You know, if you look at the markets and you follow the money, you can see that the big international companies, or you know, they call them integrators. Integrators are the ones that produce and find oil, they refine it, they market it, they make it into chemicals, they transmit, they do everything from finding it to selling it and everything in between. The integrators, their productions aren't growing. They're having a tough time selling the reserves, and those prices are coming down of those stocks, like the Exxons and the Chevrons and all those. The big integrators, the big international companies just aren't performing well. If you look at the companies that are performing well, it's these companies that are smaller, more nimble. When oil prices get, you know, these big oil companies, they shut down some of these oil facilities because they can't make it profitable. It's not worth them. It doesn't make a difference if you're Exxon is almost a $500 billion company. Would a couple $1 million make a difference to their bottom line? No, it doesn't. So they sell it to these smaller companies that a couple $1 million will impact their. Actually, it's more than that, but it can have an impact. So at $100, they're buying these. A lot of these smaller companies are buying, some of those closed down reserves, and you're right. The technology with horizontal drilling and some of these mapping that they're able to do with computers at $100 a barrel, it is profitable to go back and open up these mines. And so and also too, there's things called, kind of alternative energies where they're going after shale and what's also happening too, if you go out into the Gulf of Mexico, they're finding a lot of oil that wasn't feasible to go after, both technologically and also economically. And so you really see a lot of offshore drilling, because a lot of like you said, the easy stuff is gone. You know, the low-hanging fruit is gone, and it's going to get more expensive, more difficult to go after that stuff that's still left, and what they're also doing is going offshore. So to answer your question, I think, one of the things, you're absolutely right, it's these independent, smaller exploration production companies where they can grow the reserves, where right now, if you look at those reserves, we look at those companies, and you can buy those reserves, and a lot of them are domestic. You can buy them for like $20 a barrel.
Well, Dan, we're going to take a quick break now and go get some of the finest known facts, and we'll come back and pick up this issue again because it's a great topic.
Okay.
Welcome back to the Wealth and Wisdom Show with the Market Guys. When we went to break, we were talking about the oil market and $100 oil and how to invest in this market and how to prepare for the months ahead. And when we went to break, Dan, you were discussing about many of the oil companies, even though oil is up at $100, value their reserves at just $20 a barrel.
Yeah, I think what's happening is Wall Street is used to valuing companies based on earnings and also cash flows, which is a very good way to value a company. And because of that, these oil companies or energy-related companies have pretty low valuations in terms of if you look at PE multiples. One of the things that we look at, and I'm going to throw out some statistics here in terms of why we believe in this story.
Dan, just a quick question for you. PE multiples for maybe some of our newer viewers who are getting familiar with investing. Can you explain the concept of a PE?
Glad to. It's your price over earnings and how much you're willing to pay for a dollar of earnings. And the market multiple of what the average stock price is probably selling for about $15. The average oil stock, energy stock, is selling anywhere from 8 to 12. Obviously, we like the ones that are selling for $8. So you're getting about half the price for these energy companies that we think are extremely valuable, and that's part of why we like these companies, is because they're very cheap. But, I'm sorry, you had another question?
And most of them also, especially the bigger ones, they also pay dividends too, right?
Very
so
nice
we should
dividends.
hit on that concept for a second too.
Yeah, part of their profits they pay to the shareholders in the form of dividends. And what you want to see is that they increase those dividends over time. A lot of them do. And you also want to make sure that the payout ratio, the amount that they pay from the earnings, is reasonable so that it can grow over time. And a lot of those are very favorable. If you look at if you have a brokerage account with a lot of firms, they have what's called a S&P, or Standard & Poor's stock report. One of the good things about those reports is they give you a 10-year track record. And what you want to do is focus on these companies that have a 10-year track record that show the dividends rising and that the payout ratio is reasonable. I would say less than 50, closer to 40% of the payout is for the dividend. If it's like 60 or 70, that means that dividend probably not grow, and the company's not growing, and they're paying too much out, and they're not able to invest in the company. So, I think dividends are becoming a very important aspect. But as we were talking about the integrateds tend to pay a little bit more on the dividend side. The pure exploration and companies that have a little more growth don't pay the dividends, and so that's kind of the.
If you're an investor and you see that these companies are trading at a low PE and that their reserves are being priced at $20, what companies would you go in for the long term, assuming that oil is going to stay $100 in that area?
Yeah. On pullbacks, I would buy, and I would buy some of the independent and some of the larger companies. A couple of things that we try to look at is one of the things that makes us scared is that the replacement ratios when they produce or sell some of their oil, they replace it, and the exploration production companies are pretty good at replacing it. But what they're replacing is with natural gas, which is kind of scary. They're not replacing it with oil, which we tend to use more of. And that is more in demand. And so what we try to do is focus in on the companies that have higher oil to gas ratios. And what we're seeing that's declining. And some of the smaller ones is a company called Berry Petroleum out in California.
And what is the symbol for Berry
BRY.
Petroleum?
B is in Berry, R is in Robert, Y is in yellow. That would be a good pullback. It's a small cap stock, so it's very volatile. But when we first started looking at it, it was 100% oil. And now every year they tend to replace part of it with natural gas, but it's one of the highest gas to reserve ratios. Some of the larger companies like Apache, Devon, Anadarko are also doing the same things, but they still have significant reserves in oil, which makes them extremely valuable. So those would be three that I think, if you're going to have an energy portfolio, they've got to be musts in the energy portfolio.
So that would be Devon?
Devon, the symbol is
DVN.
DVN. Buy them on pullbacks. The other one is Apache, APA is the symbol, and the other one is Anadarko, APC. Anadarko is probably maybe kind of the favorite because it bought a few acquisitions a couple of years ago and paid a lot of money for them, or a huge amount in terms of dollar amount, and the street didn't like it, so it's really underperforming. But we think there are smart acquisitions at pretty good prices. One of the things that's been happening is that the accounting rules in the United States are very strict in terms of what you can count as a reserve. They call them a proven reserve. It's not true in the rest of the world, and so those are very strict measures. The oil companies are trying to get that to be changed, that some of their reserves, they're called possible reserves and other types of reserves. Like if you go to the website like Anadarko, their proven reserves are like about 2 billion barrels. But if you look at what's possible in terms of what can be converted from potential to possible to proven, it could be as high as 7 billion barrels. So I kind of like that because I know I'm paying very little for those reserves, the access to the reserves. Now once that accounting changes, which I think they're going to push hard for, the valuation can change dramatically. And so what the street tends to focus in on is their earnings and their cash flow. These are not earnings and cash flow stories. These are asset stories that we think these assets were going to become more valuable over time. And they're mispriced because they price them on earnings and cash flow. They're not looking at how much you're buying these per barrel, and a lot of them are very cheap. So we try to stick with the ones that have really high oil reserves, and that's harder. Every year it gets harder and harder to find, but those have a good balance of natural and gas. And what's going to happen is they're all seeming to replace the reserves with natural gas, which is a really bad sign.